This presentation is for Chapter 6, Variable Costing. In Learning Objective 3, we will use variable costing to make management decisions for a manufacturing business. With the unit product cost information calculated under absorption and variable costing, managers can use the information to make decisions. In some cases, variable costing is more appropriate for decision making, but in other cases, absorption costing is more appropriate. In the long run, the sales price charged to customers must cover the full cost of the product. The full cost includes every part of the life cycle of the product: research and development, design, production, distribution, customer service, and disposal. Any fixed manufacturing costs must be included, so absorption costing is more appropriate when determining the product cost for long-term planning. However, in the short run, variable costing should be used in some cases. Short-term pricing decisions are discussed in more detail in a later chapter. In the long run, all costs are controllable. The production supervisor should focus on the costs that are controllable at the production level. That is, the variable manufacturing costs, direct materials, direct labor, and variable manufacturing overhead. Production planning decisions are similar to sales price decisions. Short-term decisions should be made using variable costing, and long-term decisions should be made using absorption costing. In the short run, production is limited by capacity, so variable costing is appropriate. Managers analyze profitability for products and segments. First, they have to determine which products to sell, and they also have to assess the success or failure of business segments. Managers can analyze the contribution margin per unit to make decisions about the sales mix of each unit's product. This exhibit shows the information for Smart Touch Learning's two tablet computer models, Standard and Premium. Notice that the Premium model, which has several superior features and costs more to manufacture, sells at a higher price. The cost data for both models is provided on this slide. So many companies will divide their business into segments. A business segment is just an identifiable part of a company for which financial information is available. Businesses can be segmented by geography, customer types, products, or even salespersons. The contribution margin ratio is the ratio of contribution margin to net sales revenue. This exhibit shows a contribution margin income statement for two territories by salesperson. It shows that even though both sales representatives sold the same number of tablets, Salinas had higher revenues, whereas Carey had a higher contribution margin and contribution margin ratio. So this exhibit shows the contribution margin by product for each sales territory. Salinas' sales mix was 68% standard units and 32% premium units. Carey's sales mix was 92% standard units and 8% premium units. Because the standard model has a higher contribution margin ratio than the premium model, Carey was able to contribute more to the company's profits. Now this exhibit shows the income statements in a contribution margin format for two accounting periods for Smart Touch Learning. At first glance, it appears that it was a decrease in the number of units sold from 500 units in period 1 to 400 units in period 2 that caused a decrease in contribution margin. However, that doesn't explain why the contribution margin ratio decreased from 38% to 32%. Remember, a change in sales volume does not affect the contribution margin per unit. This exhibit shows the contribution margin income statement divided into various components: total, units, amount per unit, and percent of sales. The change in contribution margin was the result of changes in both components, units and amount per unit. In other words, there was a volume effect and there was a price or cost effect. Further investigation reveals that direct materials cost increased by $60 per tablet, causing variable manufacturing costs to increase from $270 to $330 per tablet. The change in sales price by $50 per unit did not offset the increase in cost per unit. So this exhibit summarizes the situations in which managers must make decisions and the costing system that is appropriate in each situation. In setting the sales price and planning production, in the long run, absorption costing is most appropriate. However, in the short run, variable costing is more appropriate. In controlling cost, upper management will usually use absorption costing because they will be making more long-term decisions. However, lower management should only use variable costing because normally they can't control fixed cost. In analyzing profitability and determining sales mix and analyzing contribution margin, variable costing provides the best information. And that is the conclusion of the demonstration for Learning Objective 3.